Picture this. It's 2 a.m. somewhere in a slightly too warm apartment. There's a person staring at a laptop screen with one hand wrapped around a cold cup of coffee and the other hand furiously typing out a Google Doc titled, "And I promise you this is real, big idea, do not delete." The document has exactly 3 sentences. One of them says this could be bigger than Google. Another one says call mom tomorrow. And the third one is just the word synergy in bold, for reasons that are entirely unclear. That person? That's a founder at level 1. And over the next however many minutes, we're going to walk through every single level of what it takes to go from that 2 a.m. Google Doc to ringing the bell on the New York Stock Exchange. Buckle up, because this journey is equal parts inspiration, humiliation, and a crash course in never sleeping again. 1. The idea stage. Level 1 is the idea stage, and it is simultaneously the most exciting and most dangerous place a founder can be. Exciting because everything is possible. Dangerous for exactly the same reason. Here, the founder has spotted what they believe to be a gap in the market, a problem nobody has solved, or solved well enough. Maybe they got annoyed trying to find a parking spot and thought there should be an app for this. Maybe they noticed their grandmother struggled to get her prescriptions delivered. Maybe they just really hated their day job and figured there had to be a better way. The classic mistake at this level is what experts call the solution in search of a problem. That's when a founder falls in love with their idea so hard and so fast that they forget to check whether anyone actually has the problem they're trying to solve. It's like spending 6 months building a magnificent, state-of-the-art umbrella and then realizing you live in the Sahara. The antidote? Talk to people. Not your friends. Your friends will tell you it's brilliant because they like you. Talk to strangers. Talk to potential customers. Ask them about their pain points before you even mention your idea. The legendary investor Paul Graham calls this doing things that don't scale, and it starts here, in the very first conversations that shape everything that comes after. Founder hack number 1. Before building anything, interview 20 strangers about the problem. If fewer than half of them describe the pain unprompted, pause and reconsider. At this stage, you have no product, no team, no money, and no traction. What you do have is curiosity, conviction, and, if you're smart, a notebook full of things real people have complained about. That notebook is worth more than any pitch deck at this point. 2. Validation and MVP. Welcome to Level 2, Validation and the MVP. MVP stands for Minimum Viable Product, which, despite what a lot of first-time founders think, does not mean the product I built over one weekend that is definitely not ready but I'm shipping it anyway. It means the smallest, simplest version of your solution that actually delivers value to a real customer. Think of it like a restaurant testing a single new dish before redesigning the entire menu. Here's a remarkable piece of startup history. Dropbox, now worth billions, didn't start with a product. It started with a video. Founder Drew Houston made a 3-minute explainer video showing how Dropbox would work, pointed it at a tech-savvy audience, and overnight grew his waiting list from 5,000 to 75,000 people. No code. No app. Just proof that people wanted the thing. That is validation done right. Another beautiful example is Airbnb. In the very beginning, Brian Chesky and Joe Gebbia didn't build a platform. They put air mattresses in their own apartment, photographed it themselves, posted it online, and charged strangers $80 a night to sleep there. They were the product. They tested the idea with their own bodies before writing a single line of scalable code. The question this stage answers is brutally simple. Will people pay for this? Not do people think this is cool? Not would you use this if it were free? Pay. With actual money. Because people's wallets tell the truth in ways their words never do. If you can get even 10 people to hand over cash for your early, rough, somewhat embarrassing prototype, congratulations, you have something. If you can't, you need to go back to level 1 and reconsider. 3. Pre-seed and first funding. Now we enter level 3, pre-seed funding. This is where the founder, who has by now probably burned through their savings, maxed out at least one credit card, and had at least one anxiety-inducing 3 a.m. conversation with themselves about whether to quit, starts looking for outside money. Pre-seed rounds are typically small, anywhere from $50,000 to $500,000, and they come from 3 main sources. First, there's friends and family, which sounds charming until your Uncle Bob is asking for weekly updates on his $10,000 investment and you still don't have a single paying customer. Second, there are angel investors, high net worth individuals who invest their own money in early startups in exchange for equity, which is a fancy word for ownership. Third, there are early stage accelerators like Y Combinator or Techstars, which take a small equity stake, usually around 7%, in exchange for funding, mentorship, and a network that's genuinely worth more than the money. Y Combinator, by the way, has a staggering track record. Since 2005, they've funded over 4,000 companies, including Airbnb, Stripe, and Dropbox, and those companies have a combined valuation in the hundreds of billions. If you get into YC, you go. Full stop. At this level, the pitch is everything. And here's the thing about pitching, it's not a speech, it's a conversation. The best founders can explain their company in a single sentence that makes the listener immediately understand the problem, the solution, and why this team is the right one to build it. The format Silicon Valley uses so often it's practically a cliché is, we are the famous company for underserved market. Simple. Sticky. Dangerous if overused, but effective if accurate. Founder hack number 2, your pitch deck should be no more than 12 slides. If you need more, you don't know your business well enough yet. 4. Building the team. Level 4 is the one that sneaks up on founders the fastest, building the team. Because up to this point, the founder has been the everything, the CEO, the engineer, the salesperson, the customer support agent, the janitor, and occasionally the therapist for the plant on the windowsill. But there comes a moment when the company can't grow unless the founder starts letting go of things. Hiring is arguably the most important skill a founder can develop, and it's also one of the least taught. The first hires are disproportionately important, not just for what they can do, but for the culture they help establish. Early employees define what normal looks like at your company. Hire a brilliant jerk, and you're signaling that being brilliant makes the jerk part acceptable. That signal spreads fast. The best founders hire for missionaries, not mercenaries, a phrase borrowed from legendary venture capitalist John Doerr. Missionaries believe in the mission. They'll work harder, stay longer, and care more deeply when things get difficult, and things will get difficult. Mercenaries are in it for the salary, the title, or the exit. They are fine when things are good, but they're the first ones to quietly update their LinkedIn when turbulence hits. A practical test many successful founders use. Would I be comfortable if this person represented the company to our biggest customer? If the answer is anything other than a clear yes, keep looking. You'd rather have a smaller team of people you trust completely than a larger team with one weak link that could unravel everything. 5. Product market fit. Level 5 is the holy grail, product market fit. This is the term used to describe the magical moment when your product doesn't just solve a problem. It solves it so well that customers drag other customers in. When people would be genuinely, viscerally upset if your product disappeared. When growth stops being something you manufacture through marketing and starts being something that just happens. The famous entrepreneur and investor Mark Andreessen described product market fit this way: you can always feel when product market fit is not happening. And you can always feel when it is. Customers are buying the product just as fast as you can make it. You're not having to push customers in the door. They're breaking down the door. Sean Ellis, who coined the term growth hacker, developed a now famous survey with a single question: how would you feel if you could no longer use this product? If more than 40% of your users say very disappointed, you have product market fit. If fewer do, you don't, yet. Slack, back when it was first launched internally, had that 40% threshold crossed before it ever went public. Slack grew from zero to a $7.1 billion valuation in 5 years. That's what product market fit, paired with smart execution, can look like. Getting to this level often requires iteration, sometimes dozens of pivots, feature cuts, additions, and total reinventions. Instagram started as a location-sharing app called Burn. Twitter started as a podcast platform called Audio. YouTube started as a video dating site. The pivot is not a failure. The pivot is learning, applied. 6. Series A, B, C, scaling. Now we hit level 6, the scaling phase, otherwise known as Series A, B, and C funding rounds. If the pre-seed was about surviving, and the seed round was about proving the idea, these rounds are about pouring gasoline on a fire that's already burning. A Series A round typically raises between $2 million and $15 million and is used to hire aggressively, build out the product, and begin expanding to new markets. Series B, often $15 million to $50 million, is about scaling what's already working. You know your acquisition channel works. You know your unit economics make sense. Now you do more of it, bigger, faster. Series C and beyond are about going after dominance, entering new geographies, acquiring competitors, or building complementary product lines. This is also the level where things get complicated in ways a founder couldn't have imagined back at that 2 a.m. Google document. You're now managing dozens or hundreds of people. You're accountable to a board of investors who have strong opinions. You're navigating regulatory environments, managing company culture at scale, and balancing short-term quarterly metrics against long-term vision. The founder who was once a scrappy problem solver now needs to become something closer to a general, someone who can set strategy, delegate fearlessly, and inspire without micromanaging. Founder hack number 3, document your culture explicitly before you need to. By the time culture feels like a problem, it's already a crisis. Many founders hit a wall here that nobody warned them about. The skills that got you to Series A are not the skills that get you through Series B. Building is different from operating. The founder who was brilliant at 0 to 1 often struggles at 1 to 100. This is not a character flaw. It's just the reality of different growth stages requiring different leadership styles. The wise founder knows which mode they're in, and surrounds themselves with people who excel at the modes they don't. 7. Unicorn status and growth. Level 7 is where the numbers get surreal. Unicorn status. A unicorn, in startup terminology, is a private company valued at over $1 billion. The term was coined in 2013 by venture capitalist Eileen Lee, who pointed out that such companies were as rare as mythical creatures. Back then, there were about 39 of them globally. By 2024, there were over 1,200. Make of that statistical shift what you will. At this level, the company is no longer a startup in the traditional sense. It might have thousands of employees, operations in multiple countries, and complex infrastructure that rivals that of legacy corporations. The founder's role has transformed entirely. They are now a public figure, giving interviews, testifying before regulators, appearing on magazine covers, and navigating a scrutiny that very few humans ever experience. This is also where the existential questions get louder. Do you sell? Companies like Instagram sold to Facebook for $1 billion in 2012 with just 13 employees. That decision made its founders wealthy beyond imagination. But WhatsApp sold for $19 billion just 2 years later. There is no formula. Every exit is a bet on the future, made with incomplete information, under enormous pressure. The founders who navigate this well tend to be ruthlessly honest with themselves about what they want their legacy to be, not just their bank balance. 8. The IPO. And finally, level 8. The IPO. The initial public offering. The moment when the company's shares are offered to the general public on a stock exchange for the first time, and all those late nights, all that anxiety, all those pivots and fundraising pitches and difficult conversations crystallize into a number that scrolls across a ticker on national television. An IPO is not just a financial event. It's a transformation of identity. The company goes from being accountable to a small group of private investors to being accountable to thousands, sometimes millions, of public shareholders, quarterly earnings reports, SEC filings, and the relentless commentary of Wall Street analysts. The founder, if they are still CEO, is now running a publicly traded company. That is a fundamentally different job than the one they had at level 1. The logistics alone are staggering. In the months before an IPO, the company goes through what's called a roadshow, a whirlwind tour where the leadership team presents to institutional investors across the country, sometimes doing 4 meetings a day across multiple cities, trying to build enough demand to set a strong opening price. The investment banks underwriting the IPO, Goldman Sachs, Morgan Stanley, the big names, charge fees of around 3.5% to 7% of the total money raised. On a $1 billion IPO, that's up to $70 million in fees. Welcome to high finance. And then there's the moment itself. The founder walks onto the floor of the New York Stock Exchange, or hits a button remotely if they're a tech company listing on NASDAQ, and they watch their company's stock begin trading. In 2012, Facebook's IPO raised $16 billion, making it one of the largest in history. In 2019, Uber's IPO raised $8.1 billion. Airbnb's 2020 IPO, launched in the middle of a global pandemic that had devastated travel, raised $3.5 billion and gave the company a valuation of $47 billion on day one. The crowd gasped. The founders cried. The market did what markets always do. It formed its own opinion, completely indifferent to sentiment. Remember, an IPO is not the finish line. It's the beginning of a new race, with new rules and a very different audience in the stands. Here is perhaps the most important thing to understand about this entire journey. Almost nobody makes it to level 8. And that's okay. The vast majority of startups that begin at level 1 fail. Some estimates put the startup failure rate at around 90%. Of those that survive, most exit through acquisition, not IPO. And of the ones that go public, most don't ring the bell themselves. The original founding team has often changed, evolved, or been replaced along the way. But here's what the numbers don't capture. Every level of this journey teaches something that you cannot learn in a classroom, a book, or a YouTube video. The courage of a level 1 founder who builds something from nothing. The resilience of a level 3 founder who gets rejected by 40 investors before finding one who says yes. The wisdom of a level 6 founder who hires someone smarter than them and is grateful for it. The grace of a level 8 founder who, standing at the top of the mountain, remembers the 2 a.m. moment that started it all, and understands that the mountain was never really the point. The point was the climb. The things you figured out along the way. The people you brought with you. The problem you actually solved, not the one you thought you were solving when you opened that Google Doc at 2 a.m. with synergy in bold for no discernible reason. So wherever you are on this journey, whether you're at level 1 with a half-baked idea and a lot of nerve, or somewhere in the middle with your head barely above water, or looking up at the top wondering if you'll ever get there, just know this. The people who made it weren't fundamentally different from you. They were just unreasonably stubborn about a problem that mattered, for long enough to figure it out. And that, more than funding, more than connections, more than any specific business insight, is the real secret behind every startup that ever made it from a Google Doc to an IPO. Now, go delete the word synergy and write something real.